your IRAs and your retirement money, cash in all your insurance money, spend your pension, and just go out and spend it on booze and women and having a big party. When you're finished spending all the money and it's all gone, there are consequences. You can't just pretend it didn't happen, right? And that's what we did as a nation. And there are consequences, and the government can't wish it away with some combination of fancy programs and agencies and gimmicks with all these weird acronyms and say, aha, this is the solution, right? There is no miracle cure.
So you don't see any plausible way of mopping up that excess liquidity in the banks that Bernanke says he can do and to avert a
Of course not. It's all just talk. Because how is he going to – he's basically saying, I can pump in all this extra money. I can keep interest rates really low. I can print a lot of money. I can get people even more indebted than they were before, right? I can get them even more addicted to cheap money. But then if we start to see prices starting to rise, I'm going to quickly take away all that cheap money. No, he's not. If he's going to do that, then why just put the cheap money in there in the first place? Because what he's saying is, I'm going to make the problem bigger, and then I'm going to solve it. Because if he does what he says he's going to do, I'm going to withdraw the stimulus. Well, now it's worse. We've got even more debt. We've got a bigger problem. So he's full of it. If he's going to administer the tough medicine, why not administer it right now? Why let the disease get worse and then administer it when it's going to be even more painful? It's all he's just saying what he has to say. Because if he told the truth, well, no, we're just going to let the inflation run out of control, then the dollar would collapse right now. So he has to lie. But people have to be smart enough to see through it and understand that, of course, he's lying. He can't tell the truth. And his actions prove he's lying. Because if he really meant what he said, he wouldn't be doing what he's doing right now.
Okay.
All right, thanks for the call, Greg. Next I got Greg in Virginia. Greg, you there?
Hey, Peter, how you doing?
Good.
My question is about gold. I was kind of wondering, how would you spot a bubble in gold? Obviously, nominal price is not going to tell you anything if there's inflation and whatnot. Would you look to other commodities?
Look, it's always hard to know, but I would think that when you get a bubble, right, as opposed to, people say, look, was oil a bubble when it was $150 a barrel? I still don't think it was a bubble. It obviously got ahead of itself, and it obviously had a huge run-up, and then it dropped. But that doesn't mean it was a bubble. Obviously prices got ahead of themselves. I think oil is going to get back above $150 a barrel. I think we're going to take out that high, which will prove then that it really wasn't a bubble because, the high will be eclipsed. But a real bubble is like a mania. It's like an attitude. It's not simply price going up. You can have prices going up without it being a real bubble. So when you're talking about a bubble, you got to think about something like what happened in the real estate market or something that happened in the stock market. When you get this can't lose attitude that that kind of the whole it seduces the entire country, a huge community of people who, as a group, come to the same conclusion. Right, that you can't lose in real estate. Everybody knew that you couldn't lose in real estate. Everybody wanted to own real estate. Everybody was buying real estate. Real estate was all anybody talked about. If you were in a restaurant, if you overheard conversations, it was about houses that somebody bought. Everybody talked about remodeling and doing this and how home ownership was the best investment. You're investing in your future. You have this attitude, and then you get prices that don't reflect reality. They reflect this attitude. And you get all kinds of rationalizations about why these high prices are okay, why rents don't matter, why, all this nonsense, just like we had with the stock market. So for there to be some kind of bubble, I think, in something like gold, I think you're going to have to see that kind of attitude among people buying gold, that it's almost universally accepted that gold can't lose, that you can't lose money owning gold. It's the only good investment. It'll always go up, and everybody will own it. Your friends will own it. Your coworkers will own it. You'll overhear conversations about it. There'll be gold coin shops sprouting up all over the country, right? It'll be, so everybody will be buying it. And if you tell somebody that you want to sell your gold, they'll say, what are you, crazy? Why would you want to sell gold? I mean, that is what you're going to have, that kind of, to get a bubble. I think it might happen, but I don't think it's there now. And I think that if prices are going up, it's not because gold is in a bubble if you don't see those things. It's simply because the prices go up.
I'm not thinking it's in a bubble right now. I'm just, in the future.
But yeah, those are the signs. I mean, look, if one day, all of your neighbors own gold, if everyone at your office owned gold, if you take a cab ride and the cab driver is telling you should be buying gold and where the best gold dealers are, then those are good signs that there's a bubble in gold.
Okay, so avoid the bubble. How about how would you know what do you look at when you say, okay, gold's not a good buy right now? What other commodities you might, maybe silver or diamonds or anything else?
Well, I think gold is a good buy right now. I think silver is a good buy as well. I think it makes sense to own them because the key is to get rid of dollars. Dollars are going to go down, that's for sure. And so you want to own something to protect your wealth. Anyway, I didn't realize that it was already got 20 minutes left of the show, and I got quite a few people on the line. But anyway, thanks for the call, Greg.
But
let me go to Donovan in Kentucky.
Hi, Peter. Can you hear me?
I've got you.
All right. First of all, I missed you on Freedom Watch today. Hopefully, you'll be back next week.
Yeah, I thought I was supposed to be on the show today. I was actually in the city, and I was going to go by the studio, but for some reason they didn't want any guests, or they didn't. I don't know, whatever the reason they didn't want me on.
I actually read an interesting piece. I think it was on Bloomberg, but I can't remember who originally published it. They provided an interesting explanation for why the Fed was actually thinking about issuing their own bonds. And the theory is that in order to unravel all of this insanity that the Fed has done by buying up all these mortgages and buying up all these treasuries and so forth, they can't just unwind them by selling them back onto the market because they end up creating the same problems that they have now. So
of course, that's part of the idea that they can take back the liquidity. How are they going to put back into the economy all the toxic assets that they took out of the economy to get it, theoretically to grow again? They're not going to be able to put it back in.
Right. Well, the theory is that the magic bullet that they can use is if they issue their own debt instead of reissuing back this debt that they bought, so they can prop up their liability side on their balance sheet. They could try to soak up their own liquidity by paying it back in their own bonds, essentially remasking and acting as a derivatives market for all this crap.
Yeah, well, the whole thing is nonsense, and it would be the equivalent of the Fed issuing more treasuries, because the bonds would basically have, the full faith and credit of the Fed's ability to print, which would basically make them indistinguishable from treasuries. So the whole thing is nonsense.
Yeah, except that I think their theory is that they're wanting to keep the treasury prices low, so if they make their bond prices skyrocket,
and the whole thing is crazy. The Fed is not supposed to issue bonds. The Fed's liabilities are the currency, the Federal Reserve notes. Their notes, that's their liability. Their asset is supposed to be the government bonds or gold or whatever they own. They're not supposed to. So basically, right now the Fed issues short-term liabilities that don't pay interest, right? Currency. What they're saying is we want to issue interest-bearing notes as opposed to the non-interest-bearing notes that we issue now. But the whole thing is crazy.
Yeah,
and there is no way out of this mess.
The other question I have for you is that I heard that China is starting to actually rebuy or re-ramp up their treasury purchases, and I didn't know if you had heard or anything, any rumblings.
I don't know. I haven't heard that. I noticed interesting that Goldman Sachs came out today and upped their GDP growth rates for China for the next couple of years. And I think by next year they've got China's economy back growing north of 10% again, which is certainly very interesting and supports what I've been saying about the decoupling and the fact that the Chinese economy can function very well without lending money to Americans to spend. But anyway, I want to try to get through these last calls. So thanks, Sarah, for calling.
Sure, thanks a lot.
All right, let me take no new calls. I'll try to get through the 4 calls that are on hold because we've got about 15 minutes left. Let me go to Lewis in California.
Hey, Peter, how you doing today?
Okay, how are you, Lewis?
Good. Hey, question about your book, Crash Proof. I've read both of them. In Crash Proof, one of your chapters, it says that in '63, the redemption clause was eliminated completely, rendering the U.S. currency intrinsically worthless. But then